Start. Quickly look at some warm-up exercise. What we did, in fact, let me revise with you. One would- We started with capital structure. In capital structure, we started with financing decision. We started with the financing decision, and under this concept, we were taking a call from what source to raise money. We had three major sources: equity, preference, debentures. As of now, what we've done is whichever source gives you highest EPS, we'll go for that source. Then we learned EPS formula, what was there. Then I had given you a small example in which we have learned that how exactly the structure would be there. Two variety of questions we covered in which it was altogether new equity, debt, equity plus debt plus preference. And second variety what we had was in which it was a case of the old firm, in which the old debt would remain as it is. If something is new, that will come in the debt option. That was there. So what we have done is either it is a case of a new scenario or it's a case of an old company. In the old company, debt would remain as it is. That means in case we have the debt 2 lakh old, whether you raise money by equity, debt or preference shares, the old will come in everyone. Then we checked some ratios to be used for this chapter. That was return on investment, return on children's fund, and return on equity children's fund. It was what level are we comparing? If level was for the company as a whole, it was capital employed. If it was for the only for the shareholders, it was preference plus equity. It was only for the equity holders, third one. And then we have seen a small example in which we can find capital employed via liability side or asset side. Same thing will come back in the chapter ratios. It's not that this is over, and this you might have done in your junior classes also. After that, I think we covered some questions on this. One warm-up question I'll do, although I thought I'll give you as a homework. It could be treated as a classwork homework, in fact. That warm-up can be completed and then we settle down for the new concept. Let's quickly read out question number 5 and tell me this question is similar to which question. Read out quickly question number 5. No need to do it. We'll verbally discuss. You can try as a homework. I'll give you the solutions. This question is same as question number 1. Same as question number 1, I think. Second one, na? Wait. You can say second one. That's fine. Second, first, it's perfectly fine. Same as first and second. Slight difference is there. I'll tell you what difference is there and what is the area of a mistake. Read the lines. The warm-up exercise we are doing. It says Touchscreen Limited needs 10 lakh for expansion. Expansion is expected to yield. Yield is a return. An annual EBIT of 1,60,000. In choosing a financial plan, Touchscreen Limited has objective of maximizing per share. It is considering the possibility of issuing equity share and raising debt of rupees 1 lakh, 4 lakh or 6 lakh. That means three possible scenarios you have. Total amount required 10 lakh. 1 lakh from debt, balance from equity, 4 lakh from debt, balance from equity, and 6 lakh from debt, balance from equity. The current market price of the share is 25, expected to drop to 20 if the funds are borrowed in excess of 5 lakhs. So which level are we talking about? Third level. But you have to be careful, it's not a perfect slab. Slab would be distorted here. That means in the first case it's 1 lakh, 9 lakh equity. 1 lakh your rate of interest would be, slab is downstairs, I'll tell you. Rate of interest is 8%. And if you borrow over 1 lakh up to 5 lakh, but in the second case you need only what? 4 lakh. 1 lakh will be in the first part, 3 lakh you'll borrow. So 3 lakh you'll borrow, you'll apply 12. Now when you go for 6 lakh, you have to be very careful. It says above 5 is 18. That means if I make a slab here, let's suppose I stand here, it's a 0. 0 to 1 lakh I go. Rate of interest is what? 8 percentage. 8 this to 5. In fact, he says 5. Na? Let me do it. Says 5 is the slab. So 5 is the slab. Rate is what? 12 percentage. Rate is 12. But I'll have to end where 4. It means my 1 lakh will have 8. Next we will have this. And then after 5 he says what? Up to 18 percentage. Now if you have 6, understand what will happen here. You will have this as 1, this 4 as what? 12, balance as what? 18 percentage. In the previous question number 1 and 2, it was framed exactly same, slab levels, interest rates. In this slight difficulty can come if you are in a hurry. That means in the second part you have to stop here only. And next, when you move from 4 to, basically when you move from 4 to 6 lakh, the first 1 lakh will be 12 only, because previous slab is not. It's as good as someone has a 5 lakh salary, someone has a 4 lakh salary. So if slab rate is till 5, it does not mean that you'll change the slab. Till 5 you exhaust and then move on. Exactly same thing will happen here. So can you try this as a homework? I'll just show you the solution for it, which will be shared with you by a drive, whatever way they share the this case for 5. Two ways I'll give you solution. One is this, that's a print of a board. How to read it, I'll let you know. Solution 5 we have the capital structure. You can look at the question and tell me, are we on the right track? At least you can quickly check it out. Total amount was 10 lakh. It's actually a print of a slide, so you'll read from, what do you say, right to left. Right to left. It's a print of a board. You'll read from left to right to left. Normal solutions we have paper, that's different thing. So some solutions you'll have the board printouts. For the COVID, I had the option to take a print of a board. Now that option is not there. Anyhow, you have capital structure in this 10 lakh. Exactly, you'll take this. Then issue price was 25, 25. Third case, I think he said what? 20. You'll find number of shares. Difficulty was not there at all in the capital structure. Slight problem could have been here, which also systematically I have done. 8% will come in all the cases. This 12 will come in 2 cases, and this one was the part which we have to be careful, because when you move from 4 to 6 lakh, this will come at 12 and balance one will come at 18 lakh. That's fine. That's your homework, which you can go back and do it. Solution 5. It's the starting of the class. I've given you homework which has been discussed. Now let us write a new heading. That was a warm-up exercise we have done. First class exercise, what we are covering now. Write down the heading. In fact, we have done so many questions in which debt option was coming better off. In one of the question, equity was coming better off. Without doing any kind of a calculation, I can tell you or can know in the exam which option will be better. What answer would be there might not be possible, but I'll know whether first option will come better or second will come. So what I'm covering now, I'll cover instead of formula in slightly extensive form, that it will give you clarity of the theory topic, practical topic, plus by looking at the question you can make out whether we have a debt option better, equity better, why is it better. Because otherwise the topic can be finished in 5 minutes. I'll give you the formula, this is a formula, learn it and do it, but it will take me some time, so you have to bear for approximately half an hour, because I'll create some structure. At the end I'll summarize when I come back. Let's put down the heading as indifference point. So this is the second most important heading of this chapter, indifference. Indifference point. You should ask yourself question again. I'm saying whenever something starts new, although it's my responsibility to tell you what it means is, but you should be asking question, what does it mean, why do we do it, and how do we do it. How do we do it? We spend 99% of the time. If you are able to get a clarity on what is it and how do we do it, any topic I'm saying, you will not forget the concept of it. So indifference point, when the word comes, first task comes is before, because formula is something which you have to live with, whether you like or do not like. Inter level, final level, everything you'll have formulas. You should be asking a question at least when you're doing normal course. If it was a crash course, it was exam revision, then it's okay. Otherwise you should always ask a question whatever subject you are studying now or will study in the finals, that why do we study this topic and what is the applicability and reason of it. First topic I'll cover accordingly. You can put down a question mark only, put down a question. What do you mean by indifference points? And why do we study? I'll come secondary. What do you mean by indifference point? Although you should be knowing English meaning of it, unlike if your English is, you have a weak hand like me, English is weak, have a strong English, indifference point you would, what is indifference? Oh my god. You studied FM earlier or this is first time only? Or anywhere these terms have come? Huh? Why I'm wasting my time, Nalayak? You could have told me I could have finished off this topic earlier. Studied this in acha, indifference point you have studied. Difference. My god. How many are your Hindi Radu? Telugu Radu. Telugu Radu for example. Hindi Radu. Complete Hindi Radu. Huh? Kunchum kunchum. No Telugu Radu, but kunchum kunchum I know. Problem is not this subject, don't worry. I will not use any Hindi word because I keep consistency in the language whichever I teach. If I teach Hindi, I'll teach extremely Hindi. For example, numbers also when I teach Hindi, I'll take 97, 98, 99. If I teach in Hindi, I keep that consist, don't worry. What I'm asking, problem is English Hindi problem is, let me, being a Sunday today, you come early in the morning. Problem is, story building is difficult in English. We'll have to bear to some extent. That feel cannot come. For example, if you explain Bahubali someone in English, how do you explain? Bahubali coming, going. Now it's difficult. No, it is required for my subject. I cannot help it out. There would be few instances I'll require some. Yeah? So do not feel bad if slightly, because you know Telugu and Hindi masala movies when comes get energy level. English you do not get energy level. Reason being, problem is we do not know what the ending would be. You watch complete movie and tell me what the end would be. Hero will survive, heroine will survive or not, he'll marry or not. Hindi movie you ask me starting, I tell you what will happen at the end. No matter inside what happens. So that is the problem. If you know Hindi slightly, that feeling, bhavna, you understand bhavna? Not bhavna what you know, bhavna is feeling. In feelings, if you understand, my work would be done. So just understand the feeling. By chance it comes out, although I'll try. I have got that habit now. It's been almost complete 10 years in English. So I can make out conversion. But the feel does not come from inside. By chance you feel awkward, you let me know. Telugu, I've tried my best, but I am not able to learn that language. I've tried my level best. The by looking at expression of Telugu, not to feel, it's clean mind I'm saying, I cannot make out whether he's showing me love language or he's scolding me. Means I tried a lot. My daughter speaks, my son speaks, but what they say I understand. I understand by their mood, they're criticizing me or they're scolding me. They internally will speak in this language, I will not understand. Something cartel has become at the home. I learn now. My wife also knows Telugu, I do not know. Anyhow, the objective was indifference point English, you know. English no weak hand. English strong, very strong, very good. My average manage. Nalayak. Below average, Nalayak, it's a difficult paper you have to write in English. Below average. I can say below average. I'm married. You're still to get married, Nalayak. You will not, you cannot say average. At least you, this category, nothing will happen. You have to prove you know everything. Maybe you do not know. Expression should be English. Acting you can do Telugu, but expression should be English because the different class loves English only. They love Western culture. Inside Indian, outside. Once work is done, come back to India. India is a beautiful country. Come on. Let's write down indifference point. Write down. First question I'm dictating. What do you mean? What do you mean by indifference point? What do you mean by indifference point? Although some of you told me indifference point what comes, he said no profit, no loss. Now our objective is what level are we comparing? In this case, I'll actually what is the meaning of indifference point from my perspective would be I'll try to find such level of EBIT at which two options will give me same EPS. It means is whether I raise money from equity, whether I raise money from equity debt, whether I raise money from equity debt preference, any two combination I'm comparing, I'd say I have to find an indifference point. Reason of it finding is that if I do not know my indifference point, for example, when I open up a shop and I do not know where my indifference point will come, I cannot know that what rate I have to sell my goods and after what point I'll start earning profit and below what I should not go so that I do not go into the loss. In this case, it's a level of EBIT at which EPS under two options would be same. Formulas we'll create on our own, don't worry. Formulas, no matter what comes in. The question was, what do you mean by indifference point? Put down the answer. It is that level of EBIT. It is that level of EBIT. It is that level of EBIT at which it is that level of EBIT at which EPS under two options would be. It is that level of EBIT at which EPS under two options would be same. Now let me make first option. Only three sources we have learned by now, in which we learned by raising from equity money, equity debt, and equity preference. First one, let's take. I'm comparing. Let's suppose you're comparing equity share capital plan, equity share capital, the state plan. Once we know how to create a formula for one, I'm saying no matter which combination comes, we can have a combination of equity debt and equity debt also. So how can we have a equity debt? In one case, he'll say 70% equity, 30 debt. Second, he'll say 50 equity, 50 debt. No matter what he says, our objective is very clear. We have to create a formula. Now, before I create a formula, I'm doing some rough work, which will copy at the end. Tell me from the EBIT level some numbers of your choice. In fact, you can make along with me any numbers of your choice. Let's try to create a formula. My energy drink, na like. Now, let's try to create. You can put down small anything under the clouds umbrella. We'll put is part of seva. Seva means you know what? For example, someone is serving tea. That's seva. He did not ask any money from me. Go to Gurdwara, temple, donate something. That's called seva. Seva is English also seva. Hindi is also seva. Telugu also seva. Sevam. Understand? This is seva. This part. Seva in your cases, marks will not be allotted for this work. Now, like meaning is this because you have agreed. First question comes, sir, will we get marks if we write this step? No marks for any part which we do under the clouds. EBIT, any number you can tell me. From the heart we are creating this number. After that I'll create this as example. You create an example. Tell me any number of EBIT of your 10 lakhs. Any both will EBIT level will create both same. 10 lakh, 10 lakh. In one case we'll have interest, second case will not have interest. Tell me the interest amount from your choice. Any you should know how the examiner creates a question. He does not come from any Mars or Jupiter. He comes from here only. Create a question. 2.5 lakhs. Okay. Very good. Then next comes what? Equity. This will be 10 lakhs, 7 lakh 50. Less tax of your choice. 30%. 30%. This is 3 lakhs, 2 lakh. How much? 5 lakh. 5,25,000. Let me assume divide 5,25,000 by 7. Right, tell me what comes out. 70. I am assuming numbers. Equity share capital is 1 lakh here. Equity share number of actually what I'll do is I would not be given this. This is my balancing figure. I've shown you something. Now we'll have reverse calculation come here. In this case, does our EPS come same? 7. This will be 7. EPS comes same na? Even if it does not come, it does not make a difference. Now I'm creating a shortcut formula. One way is doing this. Let's look at the first part. Let's only focus on the first part. This part, which you can see on the top. I'm creating option 1 EPS share capital. Shortcut formula I'm creating. I start from where? EBIT. You subtract, interest is not there. Then you subtract what? Tax. If I do into 1 minus T, you know what you get? This is what? This is PAT. Divide by number of share under shortcut formula. The first part, try to put out the figures. The figures I've written just for the sake of understanding. If you try to put these figures, what are there? Equity share capital, these figures. It's EBIT is 10 lakh. It's 10 lakh minus into 1 minus the 30 will come 7 divided by what? 1 lakh number of shares. So how did we get 1 lakh number of shares? That I have given from my side. Don't worry, I'll create a question. You will be able to do it. This comes what? 7. Now let's create for option 2. Option EPS. Equity share capital plus what plan? Debt plan. Now in this case, you tell me how exactly the formula, the vertical line works. It works as EBIT. If you minus interest and I put on bracket, it becomes what? EBT into what? 1 minus T. That becomes PAT divided by what? Although objective here was not creating 7 in 7. This was just to make sure that what we have to get is, if I calculate, if I know basically what will I know in the question, sir? I would know the tax rate, I would know the interest, I would know N1, I would know N2, I'll have to create EBIT. If I reverse calculate both, my EBIT would come 1 lakh, which you do not have to do as of now. The objective of this whole exercise was to show you from here minus tax directly divided by this shortcut formula of EPS, EBIT minus interest into 1 minus T is a PAT divided by N2. So in case preference was there, we'll come back to preference. You can copy this formula and then I'll show you that rough. EPS under equity share capital plan, EPS under capital plus E stands for tax rate in 1, number of equity shares in option 1. In 2, number of equity If you want to copy second part, the structure you can copy. How did you get the numbers? Numbers were just to explain how the formula is created. Don't worry about the numbers. What we have learned till now is only the working part of it. I have still not entered that what is the reason or what purpose it would solve. From the exam point of view, it will solve it. It will let me know the level of EBIT at which option will have seen different permutation combinations. Don't worry. Preference dividend is there. Yes, debt is there in both. Then what will happen? Formulas will remain consistent. Only amounts would change. It's equity share capital plus debt. I have taken on the right hand side. If you want to compare, you can. Then I'll create a standard example by which we'll understand the objective of doing this exercise. You can put down a small example, calculate indifference point. Amount ten lakh. Option 1, raise entire amount share capital. Option raise 50% money from share capital at the rate rupees 100 each and balance by issue 10%. Assume tax rate. Assume tax rate 40%. 10 lakh rupees to be raised by equity share capital 100 or debt and equity combination. Tax rate is 40%. In exam, how would you solve your questions? I'll do the exact format now. This question comes, what you will do is you'll write solution. You'll write everything in the fair part only. Option 1, first we'll put down the data points of 1. All equity share capital plan amount equal to 10 lakh. Issue price the share. Number of equity shares bracket N1 10 lakh divided by option 1. Similarly, I'll do here option this data summary of the question. equity share capital, amount required, 10 lakh. Out of this equity share capital, 5 lakh. IP is issue price, 100. N2 is number of equity shares now, 5 lakh divided by 100. This we have debt. Interest rate is 10 percentage. Interest amount. Now we can put down at in difference points. At EPS under equity share capital plan. First formula was what? EBIT into what? 1 minus T divided by hmm? EBIT minus into EBIT we don't know. That is exactly what we need to calculate. Tax rate was how much? 40% I gave you. Divided by n number of shares. In fact, I can cut 1 minus T, 1 minus T. When you solve this equation, left hand side is EBIT. 2 will go here. 2 EBIT minus what? Guys, EBIT is. So how do we read this number EBIT rupees 1 lakh in language form? It means if EBIT rupees is 1 lakh, EPS under both options same. Do I need to verify if question does not ask? No need to verify at all. I'll do verification plus I'll assume two more EBITs so that I can explain you the objective of this exercise. Answer finishes here. In exam, only thing I expect from you is once you have done this part, you should always write a line. What is the meaning of EBIT? Rupees 1 lakh. I'll dictate a sentence below this. At EBIT level of rupees 1 lakh, at EBIT level of rupees 1 lakh, EPS under EPS under both the options would be same. EBIT of rupees 1 lakh, EPS under both the options would be same. Answer finishes here. Now what I am doing in the second example is, one, I'll do a proof of rupees 1 lakh. Second, if my actual EBIT, this is not my actual EBIT, this is my what should be the EBIT which I'm indifferent at. My actual could be more, actual can be less. So I'll assume two more EBIT, one less and one higher. And then I'll tell you by looking at data, we can make out whether debt plan is better off, equity plan is better off. We'll go back to the previous questions and we can check that out. Example 2. If I assume this as example 1, above 1, I'm putting this as example Calculate EPS under both the plants. Calculate. Yes. The plants at EBIT level of level of 75,000. What I have assumed is my standard EBIT I know is 1 lakh. I have assumed here that if my EBIT is more than 1 lakh and less than 1 lakh, how many EPS will come, sir? 6 EPS. Case of 6. What we'll do is we'll keep uh, this as standard, this form as a standard, and on the right hand side I'll make under one plan 2 EPS, under two plan 2 EPS, and equity share cap, equity plus debt. What I'll do is this is once I'll write these numbers, then I'll write under if EBIT is 75. So what is the EPS under equity plus debt? Then if EBIT is 1 lakh, what is my EPS plus equity plus debt? And third, 6 EPS I'll calculate. So I'm creating now calculation of EPS. So you know how much space is required. It's like 7 columns you'll be making solution. And do it along, please. It's only a calculation of EPS. Calculation of I right here. First plan was EBIT 5,000, 75,000. Either have or equal plus. Then I'll have EBIT 1 lakh. I'm 99.9% sure you do not require my help with the The number of shares we don't know. Number of shares we know now, right? 10,000 and 5,000. And interest amount also we know. It's continuation of the first example only. So if, for example, if I do here EBIT 75, 5, yes, I'll do what? First column no interest, second column interest amount was give me EBT. Then I'll have tax at the rate that, and then I have number of equity. First case are 10,000, second is, then we can calculate the EPS and net we know. I hope I've done my calculation right. Tell me the EPS. 4.5, 3, 6, 6. Then you can stop writing after. First objective of the indifference point was, first objective, it lets management know at what point we are indifferent, that we have proved at 1 lakh, which came answer in the first part. If you look at now, if actual EBIT is less than 1 lakh, which option is better off? Equity. And if actual EBIT is more, it will be always. Why it happens now? Reason is why it happens. I should be knowing it. That will become a very important financial management. In fact, the bread and butter of the financial management, if I say, is corporate finance we are talking about now. Typical corporate finance, when we take a decision, price debt is in a problem, should they raise money from where? The idea is in a problem, or I want to expand my business, should I go for the equity expansion, should I go for the debt expansion? Before I move forward, you can help me out one more part. You can let me know what was the capital employed, how much amount we wanted to raise. 10 lakh, whether by first option or whether by second. 10 lakh was the amount to be raised, no matter what happens. So if 10 lakh was the amount to be raised, in this case, how much is my EBIT? 75. Can you tell me my ROI? In all cases, no matter what is the level of EBIT, or no matter what level of debt equity you are raising, you wanted to raise 10 lakh. That was example number 1. 75 divided by 10 lakh, 7.5. Second case, ROI, ROI or return on capital employed, 10%. Third case, ROI is equal to 15. Sir, how do we calculate ROI? It's EBIT divided by capital employed. And from where did we get the capital employed? No matter which source of financing you are choosing, it's 10 lakh rupees, whether by equity or equity plus debt. Now, if you look at the data at indifference point, your ROI is 10%, and below this is 7.5 and 15. Let me go to basic structure of my first class or initial class. This is a company will have only two objectives. One is raise money from outside and then utilize the money in the business. You can raise money from three sources: equity, debt and preference share. Let's suppose in the example, what is the rate of interest? How much is the interest rate? 10. That means I am raising, what is the cost for the company? 10. Company would employ this money in the business. If they are earning more than 10, 15, 16, etc., as a general layman, it will be always apply or advise to invest or raise money by what? Debt. It's a common sense I'm talking. Do not require any kind of financial knowledge also. I'm raising money from source. If that costing of the source is less than what I earn on that, I am better off. What it means is, if I technically speak to you, if I earn 15 percentage, let's suppose, and I have to pay how much interest? 10. Balance extra 5 what I earn will go to whom? To equity holders. So EPS automatically will increase. Now, if you look at the scenario here, what we have to calculate in the second case, in the first case, what was the ROI? 10, 7. That means ROI means the amount which has been invested in the business is generating 7.5, whereas the debt which you have raised is costing how much? 10 percentage. No common sense, no common man would apply or say that you raise money from debt. Hence, equity would be better off. In the third case, when you go back, third case, my costing of the debt is what? 10. I invested in the business and generate how much return? 15. I'm generating extra return. That 5% extra which comes, debt holders I'll give only 10 only. The 5 extra will go to whom? Equity holders. So the debt option is better. That means we call this as technically, should we go for the leverage or not, or leverage is working in our favor or not. Leverage is taking of debt. I am a debt ridden company, but debt is helping my equity holders. Yes, in this case, because the money which I raise from the debt, when I invest that in business, it helps me generate some extra return. The return would go to the equity holders, and that would be reflected in the EPS. So we say, under all circumstances, Whenever your ROI would be greater than the interest rate, it is always advisable to go for debt. Prima facie, it is always advisable, but yes, you have to keep in mind that when you take more debt, the firm becomes riskier. In case you are not able to pay the debt, it can go for the bankruptcy. The Kingfisher, for example, we had a lot of examples we have in the history. Those were not Jet Airways, for example. At one point of a time, they were the king of their time because they were doing good. But the moment your earning stops, but the interest payment has to go, the problem comes in if you're not able to do it. Now let me go back to the idea example which I was taking yesterday. Idea is already in debt. If they raise a debt, there is a problem. So the share price which moved up by 20-21% was equity infusion. Because when you raise the equity, basically you'll repay the debt, and once you repay the debt, automatically your interest burden comes down. So there are different scenarios of looking. In your exam, what the question comes is are based typically on this number. Sir, do they ask any time to compare? 99% no. At 1% they can ask you, will give you that under what circumstances it is advisable to raise money from debt. Straightforward answer is whenever your investment earns more than the cost. Simple words, you should raise by that source. So my debt is costing 10, and if I invest that in business and earn more than 10 percentage, I would go for the debt option. Second, generally people will say, sir, debt saves tax, etc. But tax saving is not the only reason. If I'm in loss, then what is the use of taking a debt? If I'm in profit, yes, debt will help me in reduction of my tax also, plus whatever extra I'll save, I'll utilize here. This concept will keep coming to me in different chapters in different forms. This is only a nascent or a basic stage what we have done. Let me go back to the third question, in fact, which was star marked. If you go back previous class, let's go back to the third question. I think this was our question. This is the question you have. Answer also you'll have. This is the question you have. Answer also you'll have. Now, in this question, if you look at what was your ROI, we calculated. Look at this. This is the answer. What I have. ROI was 14. What was the rate of a debt which you were raising? 12. Is it advisable to raise money from debt? Yes, and hence the debt option came better. You can check the answer. Debt would come better. Debt would come better. So you can come to know. We have done another question in which we have left some spaces. When I'll come back to them, I'll explain what means. Any example, whatever you've done, you can easily compare. So can we compare with the preference yet? To some extent, yes. But I'm not going into that complexity as of now. As we move forward, I'll go it. This concept is the most used concept in the practical life. Anyone who's raising a debt, and if market gives thumbs up to the raising of a debt, that means their assumption is whatever money they are raising, they would be able to better off. There are companies which have a huge debt. Reliance has a huge debt. Bharti has a huge debt. But the moment Vodafone has a debt, there is a problem. Because the earning is not justifying their debt. If my earning justifies debt, that means debt is okay. Otherwise, debt is not there. Then again, you have to look at practical life, industry wise also. For example, if it's a capital intensive industry, we say capex, capital intensive, infrastructure companies or airline companies, for example, construction companies, for example, their gestation period is huge and they need a lot of amount of a debt. If I say IT companies, they do not require any kind of a capital expenditure. If I say teaching industry, for example, I do not require a lot of debt. So the moment I take debt, or these IT companies or service industries companies start taking debt, that would be a negative point from the market point of view. These are practical insights which we learn as we move forward. As of now, I'll dictate two things we have covered from this topic now. One was the formula which will come in the exam, how to calculate a difference point. You cannot avoid it. That formula has to be learned. That formula will create subsequently also. Second important is why do I calculate? I come to know a EBIT level at which my both options would be same. In fact, if you look at second option, what is your ROI? 10 percentage. What is the interest rate? Whether you raise money from debt or not, it's indifferent. It's called indifference point. Third, it tells me that after what level of EBIT I would be better off with the equity debt option. Under what level of EBIT I would be better off with the equity options. That will always come. Now, after this, I'm summarizing this topic, and then we'll see how the questions are framed in the. Let's put down objective of indifference. A very important theory, and he can frame MCQ questions interestingly on these topics. Let's put down indifference point enables indifference point enables management to know a level of EBIT. Indifference point enables management to know a level of EBIT. First point under this, the, the from the first point I'll read 1 to 3. So it enables management to a level of EBIT. First point under this now, at which both options would be indifferent. At which both options would be indifferent. At which both options would be indifferent. So how do we read sentence? You read sentence, indifference point enables a management to know a level of EBIT at which both options would be indifferent. How do I read second point? I'm just telling you. It enables management to know a level of EBIT. Second point now, below which second point is below which. Actually reading is indifference point enables a management to know a level of EBIT below which equity option would be better. Below which equity option better. Third, above which debt option, above which debt option would be better. 3 points will come to know: indifference point, equity option better, debt option better. Now why it happens? Next question I'm asking is why it happens. Why it happens? First point in this, ROI greater than interest rate. When ROI is greater than interest rate, below this put down, it can be advisable. It can be advisable to raise money from debt. It can be advisable to raise money from debt since it increases since it increases. It is advisable to raise money from debt since it increases EPS. Full stop. Next line. This situation is known as this situation is known as favorable financial. This situation is known as favorable financial leverage. Leave one line and then write. Although although with increase in debt, although with increase in debt, with increase in debt, the risk of the firm also increases. Although with increase in debt, the risk of the firm also increases. Second point, ROI less than ROI less than interest rate. Debt is not advisable at all. debt is not advisable at all. Full stop. With use of debt, after full stop you're writing, with use of debt, EPS would decrease. With use of debt, EPS would decrease. Use of debt, EPS would stop. This situation is known as this situation unfavorable financial unfavorable financial. Third point, ROI equal to indifferent. What is the meaning of indifferent position? Whether you take debt, do not take debt, go by equity, any combination, your answer would come. Now quickly read from indifference point to read down from indifference point, please. What was indifference point? We used formula, then we did some working at indifference point. At indifference point, EBIT would be same. Then I did the justification. Then I assumed if three level of EBIT are there, under what circumstances equity is better, debt is better. That was because of the reason if ROI greater than interest rate, debt is better. If ROI less than interest rate, equity is better. And why it happens is because either you are able to save more money for the equity holders, or if you have to pay more interest than you're earning, then it will be equity holders are losing their income. That was the objective. Now how the questions would come in the exam. That I think question number 6. I look at question number 6. It says a new project is under consideration in Zip Limited, which requires capital investment of 4.5 crores. Total amount required is 4.5 crores capital. Interest on the term loan is 12. Corporate tax is 50 if the debt equity ratio. So what is debt equity ratio? Debt divided by equity 2 is to 1. It means 2 rupees of debt, 1 rupee of. Calculate the point of indifference. The problem in such type of question is he has not given second option. One option he has given what plan? Equity plus debt plan. What is the second plan? If nothing is said, second plan you will assume what? Equity. You will assume all equity. That means either 4.5 crores you raise from only equity, or 4.5 crores you raise from debt and equity in the ratio of what? 2 is to 1. Let's put down solution. First option. Nothing is said. For one plan would be equity because without equity nothing can happen. First option. All equity capital. Want to write in bracket? You can write as, although there is no formal requirement of writing as amount 4 crore. Has he given the face value? Nothing given. You can assume from a choice 10, 100 does not make a difference. You can assume although face values practically are rupees 10, so I'll assume 10 only. You can assume 100. It will not make a difference because under both plans it will be same. So if for example 10 is here, number of shares would come 45 lakh. If it's 100 there, the number of shares would come 4 lakh 50. Second case also number of shares will reduce. So it does not make a difference of the face value. Practically nowadays we have a 10 rupees face value shares and 1 rupee face value share. So I'm assuming a face value of rupees 10. Number of equity shares. Number of if someone of you want to try with 100 rupees, try with 100, answer will come same. Second option no. Equity share capital plus debt. Debt by equity. 1. Size. Debt would be how much? 2 by 3. 2 rupees is debt, 1 rupee is equity. 2 by 3. Total is 3. Total is 3. Out of this, 2 parts are of debt, 1 rupee is of equity. With 3 crores. Interest rate. How much is given? 12 percentage. Implies interest amount. 3 crore into 12 percentage. 30. If I want to calculate my here is equity share capital 4 crore 50 lakh 1 by 3. 4 crore 50 lakh into 1 by 3. 1 crore. Face value assumption would remain same. Actually, face value we are assuming as the issue price only 10 and now we can do what? At indifference point. I can put down my formula at we've done this part at indifference point. EPS under first option would be same as EPS under second option. Once you've done this, let's forward. Let me put down at indifference point. EPS EPS under first option is equal to EPS under second option. First option was equity share capital plan. The EBIT what? 1 minus T divided by the EBIT into what? EBIT minus interest na? EBIT minus into 1 minus T divided by 1 minus T can get cancelled. EBIT divide by 45 lakh equal to EBIT minus what interest? See, divide by what? Three. Now you can solve. You can take 3 here. EBIT is 80 minus 1 crore 2 EBIT. Therefore, EBIT is equal to 50. To write down a statement at rupees 54 lakh of EBIT, EPS under both options would be same. At 54 rupees, 54 lakh rupees of EBIT of rupees 4 lakh, EPS both options. Ninety-nine percentage he will not ask you any kind of a justification, but I'll do once more so that you understand what is the meaning of this. We'll do in the Seva part. 54 lakh EBIT, calculate EPS for both the options. He will never ask you. It will only give you a comfort that your answer is right. What you can do in exam is what I'm doing on the paper now. You can roughly do on what you can do on the calculator is you can simply do first plan 54. Just put down. Or let's do it verbally only. In fact, putting down on the paper. 54 lakh on calculator. Right? 54 lakh. Any interest in the first option? No. Tax is how much? 50. So multiply into 50. Directly get PAT. Into 0.5. Directly get PAT. How much is PAT? 27 lakh. How many were the number of share? 45 lakh. 27 lakh divided by 45 lakh. 0 0.6. First option gives you 0 0.6. This you have to do in the exam when you calculate this. Second now, pick up 54 lakh minus interest is how much? Minus 36 lakh into 50 percentage. This is PAT divide by 15 lakh. It should come 0 0.6. If they are not coming 0 0.6 same, that means you have made a. I hope you can do. This will help you checking. This will at least come for 5 marks. That means you are confirmed your answer is right. Will come for 5 marks question. Answer is right now. Now this was our sixth question. Eighth question is same. I'll give you as a homework. Just quickly read once, please. Eighth question I'll give you as a homework. Quickly read once. Eighth question would be your homework. Quickly read once, please. If by chance I missed out, I'll just tell you what we have done. I just asked. In fact, this part what you have indifference here. What you have indifference point here is basically once you get indifference point, objective is once you get an indifference point, objective is you just put down on the calculator 54 lakh. If by chance someone has missed out, again I'm saying for the last time, just put down on the calculator 54 lakh. Put down on the calculator 54 lakh. First case there was no interest. EBT would come what? 54 lakh. And then you do what? Tax minus tax. 50% was 20. 7 lakh. This will be 20. 7 lakh. Divide by 45 lakh. This is what I told you on the calculator before this question. This will give you 0.6. Same thing you will do with 54 lakh. I am doing in rough. You should not be doing anything on the rough part also, please. 54 lakh minus 30. This will be 18 lakhs minus tax 9 lakh. This will be 9 lakhs. 15 lakhs. It comes what? Exactly, I think same thing we did now. So this is exactly I was telling you on the calculators. If they come same, that means your answer is right. Let's quickly calculate now. Question number 8. We look at it. Will be your homework. Just quickly check once. Quickly check once. Exactly same as what? Sixth answer I'll share with you. You can go back home and do same. I think it's 1 crore 50 lakh. Number of shares you'll get. Number of shares you'll get. Answer would come 18 lakh. Proof is not required. Answer finishes here only. That's eighth solution. At indifference point, EPS under first option would be same as EPS second. We have left some space in question number 6. Let's go back and read question number 6, second part. Go back and read. Sorry, 7. First part we have done. I think we were getting in the 7th first part answer. Equity share capital was better, na? Now, second part he is asking us in the 7th question. Second part he is asking us. What is indifference point mathematically between debt and common? What is indifference point mathematically between debt and common? Debt and common means debt and equity. So indifference point mathematically between debt and equity. Which options will take, sir? Option is first and third. First and third option. Let's quickly down the second part answer. Indifference point. Let's put out please at indifference point. At indifference point. Common is equity share. Common and in common and debt. Now please remember in both cases you'll have interest now. Look up. In both cases you'll have interest because old also interest was there, new also interest is there. That means formula would be EBIT minus interest into 1 minus T only. But in one case interest would be higher amount, that's combination of both of them. In second case interest would be only old. That is basically if I say common plan, this equity share capital. Basically I'm not writing because both have a debt. So what it means is your formula will become EBIT minus interest. You can just put down interest 1 to 1 minus T divided by N1, and second case also you will have interest minus in you have 1 minus T gets cancelled. So if first plan we are taking only equity plan, the old interest was what? 3 lakh 60,000. It's common plan I've taken. This is common plan. This is debt plan. And n number of shares. Number of shares here what? 10 lakh 10 lakh 50,000. Common plan I'm talking about. EBIT, and now you'll have minus 8 lakh 40,000 divide by 8 lakhs. 4 zeros we cancel, and just try if 105 divided by 80 comes perfect number. 105 divided by 80. If it comes perfect divisible number, we can do 1.12. That your life becomes slightly easier. You sit here and solve it. This will be EBIT 1.312. 1.3125 minus what? 8 lakh 40 into 11 2000. Solve entirely. The 0.3125 EBIT. 0.3125 EBIT equal to what? 7 lakh 500. EBIT is equal to. Now, can anyone read this number for me? What does it mean? If EBIT is 23 lakh 76,000, EPS under both option would be same. Now, if my actual EBIT is more than 23 lakh 76,000, then which would be better off? Debt would be better off. And if my actual EBIT is less than 23 lakh 76,000, equity plan would be better off. Is this fine? Now go back to first part and check. First part, what was your EBIT? 15. Was it lesser than this? Yes, since it was lesser, which plan was coming better? Equity plan was coming better off. So at 23 lakh 76,000, I would be indifferent. If my actual EBIT is more than 23 lakh 76,000, debt plan would be better off. If below 23 lakh 76,000, equity plan would be better off, and that is exactly what has happened in the part 1. Now let me go back and see what third says. Which alternative do you prefer? Says which alternative do you prefer, which we already said that at existing level EBIT of 15 lakh, common plan is better off. You can see that common plan came better off 0.651. Second part he is asking after that, how much would EBIT need to increase before next alternative would be best? Existing EBIT is what? 15 lakh. Break even EBIT or indifferent EBIT is what? 23 lakh 76,000. And he is not asking indifference EBIT, which he has already asked in the second point. He is indirectly asking that if you are standing at 15 lakh, which plan is better off? We know equity plan is better off. And at indifferent point, we have both plan same. The moment it exceeds 23 lakh 76,000, I have debt plan better off. Look at the language he is asked very smartly. How much EBIT need to increase before next alternative would be best? Now I know from 15 lakh I have to move beyond 23 lakh 76,000. So what is the difference of 23 lakh 76,000 and 15 lakh? 8 lakh 76. So I can say the moment I increase my EBIT more than 8 lakh 76, that will be basically more than 23 lakh 76. But increase is 8 lakh 76,000 plus. Which plan would be better off? Debt plan would be better off. I hope you are getting my point. Nothing to be verified, is only asking in the words, because if you do not have a clarity of the concept under what circumstances which would be better off, you'll always make a mistake. 23 lakh 76,000, both same. Below this, equity better off, which is this asked. Above, debt better off. Indirectly is asking how much should I move from 15 lakh above 2376. I know debt would be better off. I'll dictate this sentence. Put down. I'll dictate this sentence down. At existing level of EBIT, at level of EBIT, bracket rupees 3 lakh, common plan is better. common plan is better oblique best. At EBIT of rupees 23,76,000. At EBIT of rupees 23,76,000, there would be indifference between common and hit plan. There would be indifference between common and hit plan. Full stop. If the EBIT exceeds if the EBIT exceeds rupees 23,76,000, then hit plan would be what? If the EBIT exceeds 23,76,000, hit plan would be better off. It means EBIT needs to increase more than 8,76,000. That is basically 23,60,000 minus what? 10. Debt plan would be if EBIT exceeds fees 23,76,000, debt plan would be better off. It means EBIT need to increase more than 8,76,000, debt plan would be better off. Done. This question I think has not been asked now. Maybe it's a study material. Interesting was third part. Similarly, one more question which is not there in of reference materials you have from these, but I think this could be one of the important question language form to be asked in exam. Number 9, Global Corporation. Mark it as important. Read question once from your side, then I'll read out with you. Global Corporation. Global Corporation. Very, very important question. I'll read out. Global Corporation decided to change its capital structure. Firm is currently has 1 crore fully paid up shares. 1 crore fully paid up shares. The share commands a price of 50 in the market and likely to remain the same even after proposed capital restructuring. That means after restructuring also amount would be. The restructuring involves increasing the firm's existing rupees 9 crore 10% debt rupees 14 crores. It means as of now your debt is 9 crore, that will increase to what? 14. How much extra amount you're raising? 5 crores. The proceeds will be used to retire the equity. Sir, what is retiring equity? Buying back of equity. In 5 crores, you'll buy back the equity. The interest rate on the debt is not expected to change. That means earlier the debt rate was what? 10, now will remain 10, but practically does not remain. Practically it does not remain. The moment you start taking more debt, your risk increases. The moment risk increases, the interest rate has to increase. So he is justifying, just for the sake of simplicity, interest rate on the debt is not expected to change, and the debt investors do not perceive the firm to become more risky as a proposed dose of debt. And like in, if he would not have said this line, I was clear that it will remain 10 only. By giving lines, he confuses. Actually, want to say practically, when more debt is taken, the risk increases, and the risk increases, the rate increases. But he's saying they are not seeing the risk will increase, and hence rate would remain same. After proposed dose of debt means the additional debt which you are taking. So these lines have no significance. Basically, do not get confused in this. Practically, it will always increase. Firm will become riskier even if you take small amount of a debt. Company is in 40% tax bracket, keeping in mind EPS EBIT relationship. This is another way of giving indifference point. EBIT EPS relationship. In fact, some of the books might mention, instead of indifference point, they'll mention EPS EBIT relationship. It's indifference point only. In the context of capital structure, calculate the minimum level of EBIT that firm must earn. EPS does not change. Now let us verbally talk what will happen. Tell me the existing before restructuring. Share price is what? 50. Number of shares? 1 crore. Debt? 9 crore. Debt is 9 crore. Interest rate? 10 percentage. The tax is 40. Interest amount is 9 crore into 10, 90 lakh. That is existing. After restructuring, any change in the share price? No. Number of shares will buy back. We don't know how much will buy back. Let me take debt will become how much? 14 crore. How much increase in debt? 5 crore. With 5 crores, you buy back the equity. So 5 crore divided by 50. 5 crore divided by 50. How many number of shares will buy? 10 lakhs. That means earlier number of shares were 1 crore. You buy back 10, that will be cancelled out. New shares would be 90 lakh. Interest amount would be 14 crore into 10 percentage. How much? 1 crore 40 lakh. So what has changed? Number of shares have changed and interest component has changed. Is that fine? Let's put down the data before restructuring and after restructuring. Solution number 9. Solution number 9. Let's put down. Before restructuring, after restructuring. Share price, debt, how much? 9 crore. Interest amount I am calculating. In fact, because interest rate will remain same. 90 lakhs. 1 crore 40 lakh. Number of shares. 1 crore. This I leave blank here for the timing. Tax rate is what? Tax rate is tax rate is 40. So before restructuring, after restructuring, this is the data points what we have. Now let's put down existing debt. is 9 crore. Increase in debt. In exam, do not write increase this way. Write complete sentence increase in debt 5 crore. Because new debt is 14 crores. Share price is not expected to change, so we assume the shares would be bought back at 50 only. Number of shares to be bought 5 crore divided by number of shares after buyback. Number of shares after buyback 1 crore minus what? 1. Now we can put down at indifference. We'll write EPS under existing plan EPS under what? New plan. EPS under existing plan EBIT minus what? Interest 1 I'll put because interest amounts are different. Divide by 1 minus T divided by 1 should be equal to EBIT minus interest 2. So both have interest but different amount. Number of shares are different. So do not get confused that both equation will get cancelled. Both will not get cancelled because numbers are not same. In this case 1 minus T gets cancelled. In the first option if you look at the chart before restructuring, my interest was 90 lakh. Number of shares 1 crore. In the second option my interest amount is what? 1 crore 40 lakhs. And N2 6 gets cancelled. Gets cancelled. 10 90. When you solve the equation, numbers you'll get 9 EBIT minus what? 8 crore 90 lakh. 8 crore 10 lakh. 10 EBIT minus 14 crores implies indifference level of EBIT to 5 crore. And please do write a statement. Please do write a statement. If you want to cross check the way we have done the previous one in the calculator, on the calculator or on the workings, that at 5 crore 90 lakh EPS under both options would be same. You should always cross check so that you're confident enough. 5 crore 90 lakh minus 90 lakh divided by 1 crore should be equal to 5 crore 90 lakh minus 1 crore 40 lakh divided by 90 lakh. 3 rupees under both circumstances. Should not take more than 30 seconds to 1 minute time, and you'll be 100% confident whatever answer you got the right answer. Quickly cross check please. Quickly cross check. Now let us introduce preference dividend also. We have been doing interest equity, interest both sides. Now let us introduce preference dividend also in our working. If you have done, let me know. Example 2 on page 1.2. Example 2 on page 1.2. He says calculate the level of EBIT at which EPS at which the EPS indifference point between the following financing alternatives: equity share capital 6 lakh, 12% debentures, total is 10, or equity capital 4, preference share 2, debentures 4, assumed tax rate is 50. Very good. Now what I'll do is I can only calculate number of shares under first and second option, and after that there is nothing to worry on that front. So we can put down this way: first option, put down first option. I'll compare my second option. Come back. The first option, the equity share capital is how much? Has he given the face value? Par value face 10. So I can calculate in one. How much? 60,000. Second option also can do it. Share capital 4 lakh. Face value or par value is 10. In 2 would come. Second case, interest amount will have 4 lakh into 12. 4 lakh into 12. You can show the calculations if you are facing slightly uncomfortable. I'm directly putting the numbers quickly. Let me know what we'll have. Only 48,000. Interestingly, first case also you'll have what? First amount. But in the first case there is no preference shares. Second case, can we have preference dividend also? Preference dividend would be, sir, 2 lakh at indifference. EPS under first option would be same as yes or what? EPS under first option would be same as EPS second option. Tell me the formula under first option. Just 1 minus divided by, stop writing for a minute now. Preference dividend is there. Let's create a formula. Preference dividend comes before tax, after tax. Look up. No, do not copy anything, please. When I do EBIT minus interest, what I do, I get EBIT minus interest is EBT. When I do into 1 minus T, I get what? PAT. This is PAT level. Now I can do what? Minus. I hope this is what you will do. EBIT minus interest is EBT into 1 minus T. This is whole together was PAT. And when you subtract from here, you get profit for equity shareholders. Divide by what? Now you can go. This is how you will create a formula. And please remember 1 minus t, 1 minus t will not get cancelled now. Not applying some mathematics and cancelled out. It will not get cancelled. This will not get cancelled 1 minus t, 1 minus t, because preference dividend has come. It means preference dividend is paid after tax. Yes. So I have EBIT here minus 48,000 here. Tax was 35%, I think. So 1 minus number of shares we calculated. EBIT minus interest is same 48. 1 minus 20. Once you've done, solve this. 4 zeros. In fact, let me do simplified way. 6 divided by 4. Does it get cancelled? 1.5 na? Read number. 1 point. And what you can do is 1 minus 0.35, you take 0.65. Life will become easier for you slightly. Put here. 1 minus 0.35 is 0.65. Left hand side becomes 0.65 EBIT minus 48,000 into 0.65. How much do we get? 48,000 into 0.65. 31,200. Sir, why are you doing 0.65? It's 1 minus 0.35 is 0.65. Now this side when you go, be careful please. Right hand side, what I'll do is, I'll do EBIT into 0.65 into 2. EBIT into 0.65 into 1.5, sorry, into 1.5. 0.975. Sir, how are we doing? I don't know how I am doing. You do on your own way now, right? Anyone who can help me out? 48,000 into 0.65 into 1.5. 46,000 and 42. Basically, you just have to solve the equation. That's it. And tell me the direct answer. You take steps by step. Will come. In fact, EBIT will come here. Minus minus will become plus. I think answer will come in plus only. Whatever answer comes. 1 lakh 30. 1 lakh 7. 1,77,230. 'Done. If by chance anyone is not able to solve, when you go back home, take some rest and do the calculation again. Only calculation you will make a mistake. And problem could have been the formula which you have told me. Please remember, the preference dividend comes after tax, because my next concept will be based on this thesis only. Preference dividend comes after tax. So EBIT minus interest was EBT into 1 minus T was PAT minus preference dividend. We have done now 1, 2, 4. I'll give you sometime 7, 8. We have done 9, 10th, 11th. What's left? 13 would be your homework. Do this when you're not feeling asleep. After doing this, you'll get sleep nicely. Basically, this is nothing but it's checking your calculations. Company needs some amount. I'll just tell you what exactly means. Company needs some amount, and then he says how many level of EBIT? 500, 1 lakh 25,000, 2 lakh 50, and how many plans? 1, 2, and basically you have one plan, debt equity plan, and third plan. One thing which has been done, since you would have studied tax by now, maybe taxation, so he could have given, I think, in the first case, in the debt equity plan, EBT loss would come. EBT loss would come. Generally, you can leave as it is, but since you have done taxation by now, so institute assumes you would be knowing slightly of a tax. If there is a loss, there could be some other profit by which losses will get set off. That means loss will say what? Tax. Company will be able to set off losses against other profits. If the company has no profit from operation, losses will be carried forward. Basically, he has assumed, when you say this 25,000, if you look at this basically means he has saved loss on what? Tax on the loss. If it's a new operation, then no saving happens. He is assuming that there could be profit from one business, loss from other. That loss from other would save tax. That is the assumption. Sir, where do we study in tax? We have not studied tax. When you study taxation paper, then only set off and carry forward. Section 72 or 70, whatever section. Section 7. This series comes now. Hmm? Not done. Very good. Not done. Not done. Mark here. How do you know then set off carry? Chapter is there, but you have not done till now. Then put a star here and do. Once tax subject is over, I'll come back and only one part. So certainly I cannot go into the taxation. My subject requires it. My subject will give me a problem only when tax comes, accountancy comes. Otherwise, it does not have any problem. Rest of the plans will not have any problem. Basically, how many EPS? 5, 5, 5, and 5. 15 EPS. Oh my god. Very good. And then indifference point also. This came in which year? 2005. 15 EPS. This you can try as a homework. In case you have not studied taxation by now, then leave it. Basically, you'll study the concept called if one business has a loss, one has a profit. It allows you that you can set off your loss against profit and then do. You could have done in that only, but specific section might not have been done. It's okay. Anyhow, it has to be done after tax. Sir, can EPS be negative? Yes. If there is a loss, EPS can be negative. Idea has negative EPS. After that, 15th, 14th is also similar line, I think. Exactly same. How many plans? 1, 2, 3, 4, 5. Oh my god. 5 EPS. This came recently in the exam. 5 EPS. Again, company can set off losses against the overall profit and we carry forward next one. This came very recently. Then again, so how many we have, sir? 15, 15, 30 EPS. Homework. Homework. 13th is also homework. 15th is also, 14th is also homework. There is nothing, it's only EPS calculation. These are interesting questions I have to do. Let us do a homework in classwork. 19th question, reverse calculation. Let's do 19th. It's a reverse calculation. Look up, please. It says this also came in exam. I have not written the number because some numbers I have written, some numbers I missed out. Xylo Limited is considering two alternatives financing plans as follows. Plan A and Plan B. Particulars are given. Equity shares of 10 each, 8 lakh. Preference share given, debenture given, and total is 12 lakh capital. Indifference point is given 4 lakh 80,000. Very good, sir. Indifference point means it's EBIT given. It's EBIT given. Now, since it's EBIT given, after that he says corporate tax rate is 30. Calculate the rate of dividend on preference. Alike. We have to find this part here. Now, focus on plan A. Only on plan A, please. Focus on plan A. EBIT, do you know? If I ask you calculate EPS, how would you calculate EPS in plan A? Just focus on the plan A, these data points. So basically, you'll say what? 4 lakh 80,000 minus 12 percentage into 4 lakh, that's 48,000, into what? Into how much tax rate? 30%, into 0.7, into 0.7, divide by what? 80,000. Sir, once again, plan A focus, please. I'm saying plan A would be, it will be 4 lakh 80,000 in difference point means it's a EBIT minus the interest on debentures 48,000 into 70 percentage divide by 80,000. How much EPS do you get? 3 point. I'll put down here 3 point. How much EPS said? 7. I go slightly 3.78 after that. 7 8 complete number. You said 7 9. Complete calculator is showing what? Calculator, okay. Calculator. Very good. Now right hand side. Right hand side, tell me. It will be 8 lakhs. Very good. Eh? Wait, like slow. Afternoon time. 4 lakh 80,000. No interest. Directly 0.7 gives me PAT. Preference dividend I don't know because rate is not given. I'll put minus PD. Divide by number of shares. 80,000. Can you solve this equation? Calculate the interest amount first. Basically, it's a mathematical equation, and I think preference dividend you will get 33,600. If 33,000, basically what has happened, and the difference point EPS under two plans is what? Same na? So what I tried EPS 1, basically 1 is the missing figure. What is missing figure? I am highlighting in yellow. This is your missing figure. This preference dividend is your missing figure. This one. This is your missing figure, preference dividend. So if preference dividend is your missing figure, basically what it means? It means rest of the figures I have, I can calculate my preference dividend, and once I know preference dividend amount, I know, divide by it, you get rate. Can you try as a homework? 70% is done, 30 you can redo the working at home. This is your homework. This was done. This I'll discuss with you. This is indifference. Indifference is not over. We'll have further indifference point, but I have to teach you one new point before we go to the indifference. So let's take a quick 10 minutes energy nap and then let's quickly take a 10 minutes energy nap and then Let's start. Let's put down new topic in this. We learned indifference point. Let's put down a financial break-even point. New heading. Financial break-even point. Financial break-even point. In financial break-even point, break-even point is no profit, no loss. The heading is financial break-even point. Basically, objective is we need to find such level of EBIT at which firm is able to meet its finance cost. Called financial break-even point. Firm is able to meet its finance cost. Two fixed financial costs are interest and preference dividend. So indirectly, if you tell you that they should be how much profit they should earn so that they are able to meet the interest cost and the preference dividend cost. Or in other words, I can say EPS should be zero. EPS should be zero. When I say EPS zero, it means they're able to meet out the interest and the preference dividend. Break-even point is no profit, no loss. It's a general term. What level are we looking at the break even? That is important here. Now let's put down here, please. Financial break even point theory. It is that level of EBIT. It is that level of EBIT. It is that level of EBIT at which firm is able to meet. At which firm is able to meet its finance obligations. It is that level of EBIT at which firm is able to meet finance obligations. That is interest cost and preference dividend cost. Interest cost and preference dividend cost. The word is finance, so you have to take care of both of them. Basically, you need to find such level of profit of EBIT so that you are able to take care of interest, and it does not mean that they will earn only this much. I need minimum how much should I earn so that I am able to take care of my fixed cost. Interest cost is a fixed cost, preference dividend is a fixed cost. Second point, second way of looking this financial break-even point. It is that level of EBIT. It is that level of EBIT at which it is that level of EBIT at which earnings for equity shareholders, earnings for equity shareholders. It is that level of EBIT at which earnings for equity shareholders is zero. It is that level of EBIT at which earnings for equity shareholders is zero. Meaning of this language is what should be the EBIT after subtracting interest, after paying tax, after paying preference dividend. EPS should come what? Zero. Break even is zero only. What level of profit I am seeing that EPS should be zero. That means I am taking care of all my obligations. It is that level of EBIT at which earnings for equity holder is zero. That means you are able to take care rest of the items. Third formula, financial break even point. Third formula, financial break even point. And then leave three lines. Leave three lines and put down small example. We'll create a formula. Example. Leave three lines. FBP formula will come back. I'll ask you to create formula on your own. Let's suppose interest cost in amount term is 40,000. Preference dividend. is 24,000. Tax rate is 40%. You've left 3 lines after FVEP. Formula will be creating. Before creation of formula, let me do a statement form. I have EBIT. After EBIT comes what? Interest. Very good. After that, EBT. After that, tax at the rate 40. After that, PAT. After this, preference dividend. Then comes profit for equity shareholders. Interest. How much I have? 3,000. Preference dividend. I need to find this level. Anyone who can suggest me how should I find? Eh? It, slow old age. This is 0, so it should be 24,000. Then that is 0. Okay. Now to this to be 24, what should be the value EBT here, such that if you pay tax, basically if this is 0, I know this has to be 0 to meet 24. My profit should be 24. So with this 24, how much my EBT? Now I can say if EBT is 100 percentage, this is 40, PAT is what? 60. Can I say, I can write here EBT would be equal to what? EBT would be equal to, or EBT into 60.6 is what? PAT na? So I can say PAT would be equal to what? Mathematics only I am doing, that's it. Sorry, the EBT PAT divided by 0.6 would be equal to what? EBT. How much? PAT is 24 divided by 0.6. 60 or 40? 40,000. Stop writing for a minute now. Now understand the meaning of it, please. And in this I pay 40% taxes. Please understand the meaning. Now the meaning is, if I earn 40,000 at EBT level, then I will be able to earn 24 PAT, because government will take how much from me? 40 percentage. Indirectly I can also say this PAT is same as what? Preference dividend. That means to make a payment of 24,000 preference dividend, I will not suffice by earning 24. I have to earn 40,000. Understand what I'm saying? Let me go back to complete. Complete would be 40 plus 40. How much it should come? 80. Now please look up what I'm telling you here is. It means if my EBIT is 80,000, I would be able to take care of 40,000 of interest, 24,000 of preference dividend, and EPS would be 0. You might wonder, sir, 40 plus 24 is not 0. 40,000 plus 24,000 only 64. But in between, income tax department will come home. If they pay us the tax, no matter what you do with the rest of the money. It means to make a 40,000 of interest payment, if I earn 40,000, that's justified. But to make a 24,000 of preference dividend, earning of 24,000 is not sufficient enough. You have to take care of what? Tax. That means to earn 20, make a payment of 24, your earning has to be what? 40. Whereas to make a payment of interest of 40,000, even if you earn 40, it would be sufficient. Now try to look at the formula. Please do not copy anything. What I say is, I have to find financial break-even point. Basically, I have to take care of what? Interest plus preference dividend. So I say, if I take care of interest and preference dividend, this will be exactly amount equal to what? The break-even point. Interest I earn 40, it's manageable. But to earn 24, it is not 24. It will be 1 minus t divided by. That basically what you did, 60% here was 1 minus t. But we did with PAT. PAT is as good as what? Preference dividend. How do I read this number, sir? I read this number is, it's called grossing up. 40,000 I earn, interest pay 40, income tax department will not trouble you. But when you are paying 24, income tax department says pay us before that what? 16. That means to make a 24 payment, I have to make sure it's 24,000 divided by 0.6, that's 40,000 plus 40,000. How do I read this number, sir? I read this number as to make a payment of 40,000 interest, earn 40,000. But to make a payment of 24,000 of preference dividend, you need to earn 40,000. Because when you earn 40, you pay income tax and then the preference dividend comes. It's called grossing up. Actually, this is you have grossed up the number. In mathematics, if I say PAT was equal to 60 percentage, that preference dividend was also equal to what? 60 percentage only. You have to reverse calculate what? 100 percentage. So my formula, if I would put here, this will become interest I earn because tax department is not involved. But to make sure I have to make a payment of what? Preference dividend. I would not earning 24, but I have to gross up. It means divide by what? 1 minus tax. That's called grossing up. I hope you got the point. And these are the numbers how we do it. First, you can copy this number and then we'll write that formula. And if in mind comes why grossing up is done for preference dividend, please feel comfortable writing that preference dividend comes after tax. Hence, tax has to be first paid before the payment of preference dividend. It's a mathematics only. I'm doing nothing else. It only says that if you earn profit, you pay the interest. Tax department does not trouble you. But before making a preference dividend, tax department will say pay us our taxation first. And that means we have to earn for them also. We have to earn for preference shares also. To earn for the interest and you have to earn for preference shares both. And please try to create the formulas. If you try to cram the formulas, life would be very tough. Tax plays a very important role in financial planning. Tax plays a very important role in financial. Whether you buy a machine, you buy a car, phone, any equipment. For example, if you would have done salaries, you would have seen that what component of the salary to be paid as a salary, perks, etc. The tax planning can be done. Fine. This term we call that grossing up. Like we call it as grossing up, gross up amount. And whatever amount comes, 40,000. The way of reading is whatever amount comes, one part would be the interest, the tax component here, and second part would be the dividend. And if you feel, sir, it should have been PAT divided by 0.6. PAT, since PAT is same as preference dividend, it's as good as this one. Right? Now we have left some space in question number 11, I think. Go back. If you look at question number 11, you would have calculated, I think, first part EPS. Yes. Question number 11. What you can do is, what my advice would be, in your register means copy what you have. You can number the pages 1, 2, 3, 4, 5, 6 on the top. Copy is copy, na? Have one this, and if this question is solved on page number 4, write page 4 here. Second and third part are done on page 10, so that you know register page number 4 and 10 we have the answer. By the time you end up the course, you will not even come to know which pages answers are there. You can write in the book. For example, if question number 12 is done on page number 13, you write here page number 13 of the copy. How do we number? On the top, you can write down 1, 2, 3, 4, 5, 6, 7, 8, 9. Accordingly, you can know that what page number solutions are there. This will help you out at the end. Otherwise, at the end, you will not even remember the chapter. Don't worry. Remembering a teacher is also a great thing. Who taught you? Leave apart the chapters. After a week time, also you will not remember what happened last week. What were we talking? Question number 11. I like second part. Financial break-even point. Let's calculate financial break-even point. Second part, financial break-even points. 12th, done as a homework. First part is done, na? Second, third part you will do today only. Financial break-even indifference. You can put down advanced homework only. Second and third part you will do as a homework. Let us do this part here. Have a space here available, space here. Leave one page. Okay. Audit trail I have told you to leave one page. Second part. We need to calculate what? Financial break-even point. Calculate financial break. Let's calculate financial break. Do they have interest and preference dividend both? No, no. Three plans are there, na? So let's write the first the formula. Interest plus preference dividend. One minute. In plan A, do we have any interest in plan A? Any dividend? That means answer would be rupees 0. Very good, sir. Answer would be 0 only, na, like. Plan B. Plan B is equity plus what? Debt. You have interest from the income statement. Tell me the interest component. 8,000. What else? That's it. So plan B answer would be. In plan C, I think you have what? Preference dividend. That's 8,000 divided by what? Minus 1 minus 0.5. If you have not left this space, do on a fresh page and write the number accordingly. That means 16. Sir, how do we read this number? It means in plan A, EBIT 0, EPS would be 0. No interest, no preference dividend. In plan B, 8,000 EBIT, make a payment of 8,000 interest, EBT 0, tax 0, PAT 0, preference dividend 0, EPS 0. Plan C, EBIT 16, no interest, EBT 16,000, minus 50% tax, 8,000 PAT, and then pay 8,000 what? Preference dividend. Third part, he is asking calculate indifference point and which plan is better. Sir, we have to calculate indifference point between what? Between A and B, between A and C, and between B and C. You, if you would have asked me before foundation, should I do this course? I would have said no. The beginning of the journey, excitement was there. See foundation, enter. I'm telling you, in final, you will find that person who guided you. You can imagine your life. 31st December, everyone is out on the road enjoying. You're sitting in the class. Life, hard reality. You have to live with it now. Look at my age. After crossing such age, still I'm in class. All family friends have gone. Someone has gone Goa. Someone is going Singapore. My passport I've renewed 2 times. I've not gone anywhere outside. Third time renewal is due next month. I don't know what crime I have done. Very hard life. Leave apart Goa. Necklace Road also I'm finding tough to go evening. After your batch, some other work will come in the evening. So do not worry, it's not your life. Every chartered accountant is same. Some CAs would be busy with the deadlines. 1st December deadline, 30th October deadline, GST return deadline, income tax return deadline. Whole burden of the country is on us only. I think sometimes we were not there. Who would run the country? See? Like, do not touch the emotional points. Come back, Nalak. We can see. Indicate which plans dominate. You have to find EBIT range among three plans for indifference. We'll do plan A, B, AC, and then BC. Let me go back to event space. Have to look rightwards. Third part, plan A. Plan A is all equity, plan B is equity plus debt. At indifference point. 8 into 1 minus T divided by. I'll put NA. NA is number of shares under plan A. EBIT minus interest divided by B is number of shares under plan B. EBIT we don't know, that is exactly what we need to calculate. Divide by 10,000. Right hand side would be what? Interest was 8,000. 5,000. 1 EBIT 16,000. Then sir do it plan A and C. Plan A and C. In plan A is all equity and plan C is preference. Preference na. So formula would be sir EBIT directly into 1 minus T n of A EBIT into 1 minus T. 1 minus T, 1 minus T will not get cancelled. Minus what? Minus preference dividend divided by N. Tax was directly I am writing 0.5. Number of shares minus 0.5 EBIT. All here you take it EBIT minus 16. How much? 32. And then last part is left what? Then calculate for B and C quickly please on your own. Plan B and C. Plan B and C at indifference point. Plan B has what? PIT just into 0.5 of B equal to EBIT put here PIT, okay, 5000. Hmm. Next what? Equation cannot be. It's not necessary. Answer would come. Equation cannot be solved. There is no indifference point between. There is no indifference point. Financial plan B and there is no indifference point between financial plan B. One more language he used. Which plan dominates? Means which one is better off? He's basically talking about, you look at, says indicate if any of the plans dominate. The plan which dominates, which was getting highest EPS? Option plan B. Let's put down plan B. Plan B in fact plan B dominates C. A was the least, na? A we are not even talking about. We are comparing B and C. Let's put down the answer. Financial plan B actually in A there was no interest, no preference dividend. So we are not even talking about that. Financial plan B dominates plan, and reason for it is 1. EPS of B is what? B is better. One is this. Second is if you look at financial break-even point, which plan breaks even earlier between B and C? What is the break-even means? You'll break even earlier when in B and C. Break-even is after that profit will start na. Break-even means no profit, no loss. After that what happens? Profit starts. In the plan B, how much is the financial break-even? 8,000. In the plan C, that means in the plan B you earn anything above 8, you'll be in profit. In the plan C, 16. Now if you do the argument, sir, in one plan we can have a 0 only, after 0 only, but in that case your EPS is not better off. Understand what I'm saying? We are talking about financial plan, and that's why I'm writing the term very clearly. Financial plan which is better off. That means between interest and the preference dividend, which one is better off? The interest is better off. The interest is better off in the B, and B is interest component na. For C, I first my EPS is also lower, or B plan is EPS is higher. Second is in the B case, to make a payment of 8,000, I need to earn only 8,000. After that, I'll be in profit. For the C plan, I have to earn 8,000 for the preference dividend plus 8,000 for the income tax department. That's a double whammy for me. It's a problem for me which comes out. So let's put down the second point, please. Second point. Since the financial break-even, or we can write the financial break-even point. The financial break-even point of B is only rupees 8,000, but case of C is rupees what? 1,000. Means it will break even slightly later, so you have to earn more. Financial break even. Basically, EPS B is better. That should have been more than enough. But you have to justify that in which plan I would be better off. To make a payment of 8, I earn 8. But to make a payment of 8 in the plan C, I have to earn what? 16,000. Now look at question number 10th. The second and third part should be manageable. Q and R, PQR, I think question was there. See the PQR1. Exactly same thing you have. Exactly same thing you have. That should be manageable now. Fine. That's one part. And now you can also do the financial break-even point and indifference point for the question number 12. And we'll do one more note, which is one of the very interesting notes you have. Earlier, it was hardly touched in the exam. Of the late, institute has started moving into that kind of a note. The recent trend of the examination is moving towards the practical side of capital structuring. A very, very important note. This would be given a formula one line in your ratios chapter, which will take me some time to explain. And this ratio, what we are talking, anyone who is in the equity market, whether for 6 months, 1 year, 2 year, 50 years, he would know. And by looking at this, I can tell you whether the which company share is better off and not better off. Prima facie. Put down price earning ratio, a very, very important ratio. Price earning ratio. PE ratio. Price earning ratio. I don't know in the foundation it was there or not, but this is the one of the most used ratio. Formula of P ratio is price divided by E. P ratio, price by is price by EPS. If you remember yesterday's class, MRF, what was the price? 1 lakh 30,000 approximately. Can you tell me any competitor of MRF? Seat tires. Very good. Price earning ratio. So how do we read this number, etc.? Not even discussing how do we read. Let's go back. I'll ask you a few questions and you help me out on those numbers. MRF. Going back. Just keep in mind MRF price is what? 1,30,000 rounding off. 1,30,000 rounding off. And this is in which sector, sir? Sector is tires and rubber. That's industry, right inside. Tires and rubbers. The competitor you said was, what is the face value? Look at that face value also. 10. Very good. Go to see. Prices round off 2,500 or 400. 2,400. Face value 10. Industry tires and rubber. So both a tire company. One company is trading at 1,30,000. Second is trading at 20,500. The face value is 10 in both of them. Now, you being a chartered accountant to be very soon, and someone asks your advice now. I have to buy the share of any of the tire company. Which one is cheaper? Here it is. Very good. Now let me frame my question in a different way. I'm planning to buy a house. I've seen a property in one of the remote village side of Shamshabad. Those who understand Shamshabad, it's or you understand village area of yours. Those who are watching on Google Drive, any village area of yours. Second, I have seen a prime location of Jubilee Hills. Same height, size, width, property. Same, no change. Or let me put in different way. Let's become global. I've seen a property in New York, and I've seen a property in a village of Telangana. Same height, size, width, property. Which one would be better? Nani, you did not even take a 30-second time. When I asked about the share, quickly said 2,500 is cheaper, 2,400 is cheaper than 1,30,000. Property did not take even a 10 seconds time. Even if I would have asked you Shamshabad property or Panjaguta property also, same height, size, width. Still, which one is costly? Which one will be costly? Panjaguta. Which will be cheaper? Shamshabad. You do not even take time. Why is it so? And which one is it? I'm saying cheaper is basically the Shamshabad. That means rates are not same. Then why would someone buy? Why would someone buy the area Panjaguta? Now there has to be certain reasons why the difference in the property come. Property does not give you trouble. You can easily make Mumbai. I am buying Nariman Point. Delhi. I am buying Connaught Place. Any area you can easily make out because you see every day. Every day the land area, property area, we'll say location, etc., or which post locality, not etc. You make out in the shares. If that was the case, if MRF was costly, who will buy 1,30,000 rupees? But they are still buying. Why would they buy? Let me put in different way. If I buy a property in Shamshabad area and buy a property in Panjaguta, which property will give me higher rental income? Making investment. Panjaguta. Similarly, like when I invest in the C8 tires, I get EPS of, look at the EPS here. How much is the EPS? 130, 1.62. Let me go. That means investment of 2,400, earning per share of approximately 1,300. And if I make an investment of 1,30,000 here, my EPS is how much here? That means any kind of a asset class. I'm not talking about the shares. I'm talking about any kind of asset class. There is exception is gold and maybe one more too. Otherwise, all asset class prices are determined by the income they generate. The kind of income they generate. Since it's generating higher income, the value is higher, price is higher. The C8 is generating lower income, the value is lower. I've taken from the same industry just to do a comparison. Do not check, sir, why the face value is 10, both of them, and etc. This also will come in one of the chapters. So I'll do the extension of it. My focus as of now is only on this ratio, price earning ratio. That means by looking at absolute number, you never take. This is as good as, you know what you are telling me. You are telling me, I tell you, I ask you, there are two brothers, same class, twin, Ram, Sham. Ram gets 50 marks in the exam. Sham gets 80 marks in the exam. Ram gets 50 and Sham gets 50. Who will get beating or who will be better off? They come back home, father is waiting, loss has happened in the stock market. What will happen in the evening? To whom? Now, when you compare, if you compare these two, better off you'll feel what? Absolute number. This this is better off. But the moment I tell you he scored out of 60 and he scored out of 200, the ratio depicts differently. I hope you understand the meaning of ratio. Similarly, absolute number have no significance. Absolute number, this when you compare out of these two and when you compare out of these two, the scenario changes. Exactly same thing is happening here. When I talk about the MRF, I'm talking about a higher base price and respectively EPS is what? Higher. First of all, we have just understood that why prices are different. I have not even come back. How would I decide which to invest and what not to invest where? In this case, I'll do the price earning ratio. Let's put down the exact numbers and complete this ratio, and then I'll talk about this ratio in detail. How do you read the numbers and what calculation or what suggestion you'll give when the question will ask you something. Let's put down. This is P ratio, price by EPS. Price is actually absolute. For example, if this was the case, Reliance is in the telecom sector, but Reliance could be combination of, it's a conglomerate, so many businesses. Bharti Airtel is in telecom, Idea is also in telecom. Idea is 16 rupees as of now, Bharti Airtel is 1000 rupees. No one will buy Bharti if that is the case. There has to be some justification. If you are earning more, your price has to be more. If you are earning not, your price has to be lesser. So if I put my data here, let's suppose you can put along with me MRF, C8 tires. Sir, what was the use of face value? As of now, no use. We'll come to a respective chapter and we'll discuss same example maybe. Tell me the share price here. Approximately rounding off 1 lakh. This was approximately 1400, let's suppose. Earning per share. Rounding off, I'm doing 4000. In this case, I'll do 130. Now just calculate for me the P ratio. It comes in times. Yes. Approximately 130 divided by this 32.5. 2 decimals you can tell me. Huh? Both? This is exact. Second one. 18 point. Now I can easily take my decision. By comparing 130, I could not have taken decision. Now I can take my decision. It's as good as, let's suppose I say I bought one property for 1 crore, rental income is 10 lakh. Second property, one property I bought for 1 crore, rental income is 10 lakh. What is my return? 10 percentage. Second property I bought for 10 lakh, but my rental income is 1 lakh 20,000. 12% is not like 10 lakh property and 1 lakh 20,000. I'm saying one property I bought for 1 crore and the rental income is 10 lakh. Second property was bought for 10 and rental income is 1.2. Which is better off? The 10 lakh, because percentage wise return, what is coming? This is coming how much? 10 percentage. This is giving what? 12 percentage. Sir, we could have told you directly 10 lakh cheaper. Now let's suppose I give you instead of 120, I earn only 80,000 rent. This is only 8% return. You cannot take a decision by looking at the numbers that this is smaller, this is cheaper. By chance, what has happened? C8 was better off in the price term absolute number and proportionately also better off. How do I read these numbers? Understand the numbers. In the MRF, if I have to earn 4,000, how much amount of investment I need? 1 lakh 30,000. To earn 1 rupee, I need investment of what? 32 rupees approximately, 32.5. In this, if I earn 130, how much investment? 2,500, 400. To earn 1 rupee, investment of 18.46. Proportionately, if I do earning of 1 rupee here, earning of 1 rupee here, he is asking how much rupees? 32.5. He is asking what? 18.46. Which one is better off? 18.46. So we take decision based on P ratio. That's the way of reading. That's the way of reading. Although I'll not be doing this when I go in the solution, because your objective would not be P ratio. Our sequence will change and when I go to the question. Second important part now. Second important is the way of reading is If let's suppose I buy one share of MRF today, 1,30,000, and every year I earn 4,000. I'm assuming every year I'll earn 4,000. In how many years my recovery will take place? I invested 1,30,000, 4,000 every year you earn. So recovery will take place in 32 and a half years. We call this as a called payback period. One of the chapters will come capital budgeting. In how many years my recovery will take place? For example, you do some investment and you keep receiving some inflows. You'll say in how many years my recovery will take place? 32.5 years. In the second case, I'm saying I'm investing 2,400 rupees. Every year I earn 130 rupees. In how many years investment would be recovered? 18.46. So one will give me return in 32.5 years. Second will give me return in what? 18, 18 and a half years. Which is recovering my investment earlier? This is better off. Prima facie. Then sir, why would someone buy MRF? Because ideally, no two shares are same. Their management could be different. Their product could be different. Similarly, for example, where we are sitting here, if I buy this building and just adjacent building, both will not have a same rate. One will have a northeast facing corner, one will have a sunlight, one will not have a sunlight. So same area, same place, two identical building height and size, they will also not be same. You have to look at the potential of the earning capacity. Prima facie, if someone tells you out of these two, I have to select any one of them, which one is better off? It has to be C8. But I did not take a call by looking at 2,500 rupees. I've taken a call by looking at what? This part here, P ratio. Higher P ratio also shows that the confidence of the management would be higher, or maybe the expectation is this company will do better off in the long run. Sorry, this will do better off in the long run. P ratio is read as it's in exam or in anywhere it comes 99% chance it will not come in the prime form. It will only ask you give you price, calculate the times. But in practical life, when you go for the interviews, they'll ask you two companies I have, which one is better off? The company which has lower P ratio is better off prima facie because it gives you recovery earlier. Copy this part, I'll dictate some points. How to read 32.5. 32.5. When you buy a property, you certainly look at the location, area, rent, etc. Same is in the shares. There's no difference. The quality of the management. And you do not compare prima facie the property by looking at prices. You look at different factors. And two localities will have a different rates. Exactly two companies will have a different rates. 32.5 means below this first point. How do I read this 32.5? The way of reading. This is not a language in the books, it's we are writing from our side. If investor invests, if investor invests rupees 1,30,000, if investor invests rupees 1,30,000 today in MRF, if investor invests rupees 1,30,000 today in MRF and company earns company earns rupees 4,000 every year, company earns rupees 4,000 every year, then recovery of investment will take place, recovery of investment will take place, recovery of investment will take place in how many years? In 32.5 years. Recovery of investment will take place in 32.5 years. So does the answer come in years? No, answer comes in times. This is way of reading. If you have to explain, for example, if you tell someone P ratio of 32.5, no one will understand. If you tell him you make an investment, your recovery will take place in 32.5 years. They'll understand easily what it means. Is second interpretation of 32.5. Second interpretation. I'm not dictating a term payback period. It's actually a kind of a payback period. That will be capital budgeting term. In how many years recovery is taking place. Second way of reading 32.5. Put down please. To earn rupees 4,000. MRF only I am talking about. To earn rupees 4,000. We need to invest how much rupees? 1,30,000. To earn rupees 4,000, we need to invest rupees 1,30,000. To earn rupees 4,000, we need to invest rupees 1,30,000. Comma, it means to earn rupee 1. It means to earn rupee 1, we need to invest. We need to invest how much rupees? 32 point. This is the interpretation of it. P ratio. Prima facie, if I was not doing this chapter, and if you would have asked me which option is better off given these two circumstances, I would have said what is better off? C8 is better off. I would have said C8 is better off. But this is not you will do in the capital budgeting. There are two things to understand from here, please. One, till the time you have not purchased a property or gold or shares, you would like price to be lower or higher. Which type of price you will find? Lower. When you are want to invest but you have not invested, you want price to be lower. Let's suppose I bought the share of idea at 12 rupees. Now 16 it has become. Tomorrow I expect Monday what should happen? 14 or 18? 20, 25. That means views changes. Till the time you have not done the investment, you want price to be lower. Once you have invested, you expect price to be higher. No doubt on that. Na? Now think of a company. I'm invested in the company. I've already invested and I have to take a decision in the company. What kind of decision I'll take? Which will increase my price or decrease my price? Increase my price. This chapter is based on that capital structure. So if someone would have said I have to invest in one of them, I could have said go and invest in which company? Maybe C8. Although prima facie we cannot compare any two companies across. I have taken same industry. We certainly cannot compare IT company with the rubber company. That's unimaginable because IT companies can have a P ratio of 80, 80, 90. For example, one of the shares which I would like your generation should track since you being young age. Like a Google, we have in India something. Map My India. If it is not there, keep tracking it. You never know when it becomes Google. Not something. Disclaimer, any discussion I done in the class, any share name I take is only for education purpose. I'm not a SEBI registered analyst. So do not take my advice and invest go nalai. It's only educational purpose. You never know. It's only educational purpose I discuss. Any kind of a discussion on the shares done is only for educational purpose. Disclaimer I'm giving. By chance I have somewhere. I don't know I have it or not. Let me see. Previous batches I used to write the disclaimer also now, right? Maybe I don't have here. Disclaimer I'll put it, don't worry. So it's only for educational purpose I'm discussing. What happens is, for example, Map My India, for example, if let's suppose it becomes Google of India, you never know what the price becomes. Price is anyhow standing at 2200. Price is not important. Its total value is important. But total value is also important. That anyhow leave for some other classes, final something leave for the finals also. What it means is when you in this chapter I am saying this chapter is not asking you to take a decision on the investment. This chapter is taking you if you are part of the company and you have to take a decision, should I raise my money from equity or should I raise money from debt? Which option is better off? So I'll select that option which gives me higher what? Price. EPS we have taken as of now. Now I'll move to the price. If my share price increases, my wealth increases. Now then what was the role of this P ratio? The role will come. 2 points are clear. One, that if you invest 130, 4,000 every year, your money would be recovered in 32.5 years. Second, to earn 4,000, 130 investment to earn 1. This is the way of reading. Next line put out please. P ratio you told me what formula? Price by? Yes. Can I calculate price using this formula? Yes. P ratio into. This is called valuation ratio, which will be used extensively in your practical life and CA final. This is called one of the important valuation ratios. P ratio in this. Now put down the notes below that. Now let me put down the notes. This is something which is very new with respect to the course, because if I look at the history, maybe in last after 3-4 years or 2 years back, it was only once asked question. Now institute is back to back giving or indication that he can ask the question on the P ratio in the exam. First note put down please. Till now whatever we have done is we are selecting that option which gives what? Highest EPS na? Put down exactly same word. Put down first point. Put down. We will select that option. We will select that option which gives highest EPS. We will select that option which gives highest EPS. Next line in bold letters put accept. We will select that option which gives highest EPS. This was conventional principle of capital structure. Except below this now, second point. If P ratio is given in question, if P ratio is given in question, comma, we will select that option. We will select that option which will give which will give highest price. Price, share price, these are interchangeably used. And how can I calculate share price? I can always calculate EPS. P ratio if given, multiply and you calculate what? Price. If P ratio is given in question, we will select that option which gives highest share price. And this concept we call it as highest share price, known as wealth maximization. Tell them 10 more minutes. Wealth, wealth maximization. A very, very important part. Highest share price is wealth maximize. That means how do I maximize wealth? For example, if I have invested in idea, disclaimer again, please, anything is artificial. Comes in television, movies, all characters are fictitious nature, etc. Blah blah blah. So let's suppose I've invested. How will my wealth increase when the share price increases? Company is earning, not earning, I don't know, but the share price increases. Since I'm holding the share, my wealth increases. We call that as a wealth maximization. And entire financial management works on the concept of wealth maximization. If that is not the objective, then one of the objective, two objectives you learn with the time. One is called profit maximization, second is called wealth. Profit is short term. For example, you give the exam, pass the exam, forget. Profit maximization. Wealth is I learn something, but I'll remember throughout my life. I learned something I'll remember throughout. Wealth maximization. Exactly same thing. Companies should take such action today so that after 5, 10 years, 30, 15 years, the wealth would be created for the shareholders. We call it as the wealth maximization. Next point. Next point. If any decision, if any decision, if any decision of the company, if any decision of the company increases the share price, if any decision of the company increases the share price, then that decision should be considered as, then that decision should be considered as what? Best. If any decision of the company increases the share price, then that decision should be considered as best. So how can the share price increase when profit has not increased for the company? Think situation. Let's suppose tomorrow news comes in the newspaper. Metro rail will come nearby. What do you think the prices will happen here? Increase. Who knows? Metro rail will come in 2 years, 3 years, 5 years, 10 years. But property price will start anticipating. Exactly same thing is the company. Company has done some capital expenditure, has set up a factory. Factory will take time. Production will take time. For example, if I get the contract of the Apple and I get some contract here, it will take some time. But everyone will know that I'll start earning in the future. Exactly same thing is here. So prices start reflecting. That is what I was telling you yesterday. Nothing has happened in Vodafone Idea as of now. It's a rumor. Let's suppose if actual fund comes, we never know where it goes. We cannot know where it goes basically. So objective is any company when they're getting a funding, what kind of funding they're getting, and what would be the impact in 2, 3, 4 years. That anticipation reflects in the prices, and increase in the price is nothing but wealth maximization. In your case, he will give you what, if price earning ratio is given, then only apply the concept, otherwise do not apply. And two things I want you to be ultra clear, please. One, if you have to invest, you want prices to be lower. If you have already invested, then you never want price to come down. You want price to keep increasing. Let's look at very small question, very small question. I'll not do the bigger question on this. The which will tell you that how this concept would be applied before we wind up today. Let's come back. 5-6 minutes more will take, not more. That concept will be freezed. This is question number 15th. Market is important, please. It's an untouched area in the exam. This question. 15th. Again, I'm saying whatever discussion I'll do in the class is only for educational purpose, but I don't want you to sound stupid when you go out. P ratio, someone says, hey, we calculate price by EPS, it comes in times, that's it. This is not, you should be able to talk intellectually. It means in how many years recovery will take place, etc. Means you should be able to talk on these terms. And I'm saying it again, the more you'll read newspapers, the more you'll become talkative and the more better off it is, especially if you're looking your career in the financial side. There are a number of chartered accountants who are in the finance side. For example, if I have always been in the financial side only. Whether I was an equity research analyst, whether I was an M&A analyst, whether I was the trainer in the M&A finance, etc. I have been in this side only. It's not that, and the same degree I have CA, what you'll be getting sooner. Maybe I shifted earlier, but I love teaching, so I came back to teaching. There are n number of chartered accountants who are in the financial side and they do very good. This field has unlimited scope, but you need to have the talking skill. The more you talk, the more you read, you're able to analyze numbers better off. There is no beating. There is no second person who will stand in front of you. But anyhow, that discussion will do at some later stages. Come back to this question and read out with you. A very small question. 15th. Beta company is contemplating is thinking. Beta company is thinking conversion of 500 14% convertible bonds of 1000 each. Indirectly, he has given hint there are 500 bonds, face value 1000, 14% is rate. The market price of the bond is 1080. So if anyone buys sells in the market, that 1080 may be of no use to me here. I don't know. Bond indenture is bond agreement, provides that one bond will be changed for 10 shares. So there is an option that 500 bonds can be converted into 5000 shares. Price earning ratio before redemption is 20:1. So what does it mean? This is 20 times. That means if 1 rupee is EPS, how much is the price? 20 times. This is for not the bonds. This is for shares. This, do not get confused here, please. This is not about the bond price. We're talking about the share price. P ratio is for the share price. So how can bond have a price? Bond can have a price. Finals when will come, you come to know. Bond can have a price. How do we calculate bond? We have the formulas. And anticipated price earning ratio after redemption is 25:1. It means as of now, your 1 P ratio is what? 20. If you convert into the shares, P ratio will become what? 25. Number of share outstanding prior to redemption are 10,000. That means existing shares are what? 10,000. EBIT amounts to 2 lakh. Company is in the process of in the 35% tax bracket. Should the company convert the bonds into reason? First of all, since P ratio is given, decision would be taken on price. Now let me talk to you in different manner. Any change on the EBIT, whether we have a conversion into shares or whether the bond as it is, EBIT level I'm talking about. EBIT level will not change. As of now, when the bonds are there, what comes in my income statement? Interest. Let's suppose I convert to shares. No interest. Then I keep going down. Will the number of shares change? What would be change? For example, as of now, I have debentures. Either I keep debentures. If I have debentures, it will be EBIT minus interest, etc. Then there are some 10,000 shares. Now let's suppose I convert into shares. EBIT would not change. Interest would not come, but number of shares would increase. Will increase. So that means changes would be prima facie interest and number of shares. So let us do calculate EPS before conversion, EPS after conversion, and then we'll multiply whatever before conversion comes, we'll multiply by what? Into 20. We'll get what would be the price if we have a bonds. If we convert, we'll multiply that EPS into 25. If that price increases, then we'll say it decision is convert. If that price does not increase, we'll say do not convert. Let's put down solution. 14th was your homework, so I'll put it. Calculation of share price, and I have dictated very carefully that if P ratio is given, take decision on share price. Calculation of share. Before conversion, after conversion. EBIT. Okay. Interest amount how much? 500 shares into what face value? Into 14. Before conversion, you are paying 70,000 interest. If you convert, no interest will come. 1,30,000. Tax at the rate what? 35. Fact, tell me. This will be, I think, 84,500. This will be number of shares. Now, if I talk about number of share, old will remain same in both of them. 10,000 here, what? 10,000 here. Plus, you will have something what? New. So, how many? 500 into what? 10. He said for every bond, you are getting how many shares? The total shares would be 10,000. This will be, and if you divide by this, you'll get what? EPS is 8 point. Let's suppose there was no P ratio given. Which option was better? Conversion. If P ratio is given, please, whether EPS is better or do not better, do not stop your answer here. Multiply by, it was given 20 here and this was given 25. So price formula I know, price is equal to P ratio into multiply and tell me the price. Multiply and tell me the price. 169 216 point. Now you can write down your decision. I'll dictate once you copy that. Let's put down. Since the share price of the company increases after conversion, since the share price of the company increases after conversion, since the share price of the company increases after conversion, hence, the company should comma hence company should convert bonds into shares, comma hence the company should convert bonds into shares. Bonds are nothing but debentures only in general layman language. Company should convert bonds into. This was prima facie to explain you P ratio. What level of questions now institute is setting C in the next session. Wind up here. Homework already I have given you. Revise whatever we have done. P ratio remains an important concept, not even inter now. Finally, it's ultra important. Take care and bye bye.